Good morning, everybody. 9 a.m. Eastern time. We have a jobs report that was just released. Apple earnings, markets going crazy. I am here to break it down. My name is Gareth Unveils, and this is the game plan at verifiedinvesting.com. First off, let's jump over, take a look at the numbers. Let's see what we have. So right off the bat, what do we see? So economic data, the forecasts, previous, and the actual. So we saw very clearly here, guys, forecast was 170,000 jobs created. It came in below estimates at 150,000. Now, this is where it's kind of crazy, right? You would say, oh, less jobs, isn't that bad economically? Wouldn't that be bad for the stock market? No, it's good for the stock market. The stock market looks at a very short time frame, basically 3 to 6 months out. And in the next 3 to 6 months, this tells us that the likelihood of Fed rate hikes, additional Fed rate hikes, are now diminishing more and more. And the market loves it. The market loves relatively cheap money, at least money that's not going to get more expensive. The next number here, unemployment rate, ticked up. 3.8% was expectation, coming in at 3.9%. So again, a higher unemployment rate. Weirdly enough, the stock market wants more people unemployed because it takes the Fed out of the equation. It's just that simple. Now, you guys may say, wow, if this trend continues, aren't we going to be in a recession? Yes, we are. That eventually will be bad for the markets, bad for stocks. But the markets, again, and this is so important to understand, the markets look 3 to 6 months out. And 3 to 6 months, the only thing the market cares about right now is that we do not see the Fed continuing to hike rates. The 10-year, again, we're going to go to that chart. That's an amazing chart, folks, by the way, because we just hit my target. I gave the target earlier this week, and we just hit it on the 10-year yield. We'll touch base on that in just 1 second. Average hourly earnings. This is another positive, right? Markets had expected 0.3% uptick in hourly earnings. What did we get here? 0.2%. So people making a little less money than they expected. Again, for inflation, that is a positive thing, right? In general, people want to make more money. That's obviously the goal. But the market specifically, to get the Fed out of play here, to take them totally off the table, they want to see people making a little less money so they don't have as much money to spend on goods. Remember, supply and demand. The more people buy things, the higher price will go to meet that supply and demand curve. All right, so that's what we have here, guys. Again, in general, this was a positive for the market. This was a positive. This was a positive. You get a good number. You get a good number. That's what it went on here today, folks.